Picture this. Americans in 1929 believed they lived in the most advanced economic system ever created, where modern banking, scientific management, and rational markets had finally solved the boom-bust cycles that plagued earlier generations. Within 4 years, that same system had destroyed itself so completely that 1 in 4 workers couldn't find employment, thousands of banks had vanished, and the federal government was hiring millions just to prevent social collapse. The mathematical precision with which prosperity turned into devastation suggests something far more systematic than bad luck or poor timing. This discussion is for educational and analytical purposes only and does not constitute financial advice. What makes the Great Depression uniquely instructive isn't the scale of the collapse, but how thoroughly the system mispriced the risks it was designed to manage. Every major institution operated under assumptions that seemed mathematically sound, historically validated, and universally accepted by the era's most sophisticated minds. Banks calculated reserve ratios based on historical withdrawal patterns. Investors used margin calculations that had worked for decades. The Federal Reserve followed monetary policies that economic theory endorsed. Yet when tested simultaneously, these individually rational assumptions created a cascade failure that no single participant could have predicted or prevented. The contradiction runs deeper than simple overconfidence or speculative excess. The 1920s economic system had genuinely solved many problems that plagued earlier eras. Industrial productivity had reached unprecedented levels. Financial innovation had democratized investment. Geographic diversification had supposedly eliminated regional banking risks. International trade had created stabilizing interdependencies. Each improvement was real, measurable, and beneficial under normal conditions. The system hadn't simply ignored risk, it had systematically mispriced the specific risks that its own innovations had created. Consider the mathematics of margin buying, which allowed investors to purchase $100 worth of stock with just $10 down. This practice seemed perfectly rational when stock prices rose consistently, because the leverage amplified returns while the underlying assets provided security. Banks calculated their exposure based on historical default rates and recovery values that reflected decades of relatively stable markets. Regulators saw margin lending as a sign of financial sophistication, not systemic vulnerability. The assumption underlying every calculation was that stock prices might fluctuate, but wouldn't collapse uniformly across all sectors simultaneously. Banking operated under similarly logical but ultimately flawed assumptions. Regional diversification was supposed to prevent localized failures from spreading because different areas would experience different economic conditions. The rise of holding companies like Caldwell and Company actually seemed to strengthen this logic by spreading operations across multiple states and business lines. When Caldwell controlled banks, insurance companies, and investment services throughout Tennessee, Kentucky, Arkansas, and North Carolina, the conventional wisdom suggested this diversification reduced risk by not depending too heavily on any single market or industry. The Federal Reserve System represented the pinnacle of this systematic confidence. Created in 1913 specifically to prevent the banking panics that had regularly devastated the 19th century economy, the Fed embodied the era's faith that scientific management could solve structural economic problems. Central bankers studied historical data, calculated reserve requirements, and implemented policies based on the most advanced economic theory available. When they raised interest rates in 1931 to defend the gold standard, they were following established protocols that had successfully managed previous currency pressures. International trade relationships reinforced these assumptions about systemic stability. The gold standard created what appeared to be an automatic balancing mechanism, where trade imbalances would self-correct through gold flows and interest rate adjustments. Countries experiencing capital outflows would raise rates, reducing domestic demand and restoring trade balance. This system had successfully managed international commerce for decades, creating confidence that global economic integration reduced, rather than amplified, risks. Each component of the system made logical sense in isolation. Margin lending worked when prices rose gradually. Regional banking diversification worked when problems remained localized. Federal Reserve policies worked when applied to conventional banking panics. The gold standard worked when trade imbalances developed slowly and separately. The fundamental mispricing wasn't in any individual mechanism, but in the assumption that these mechanisms would continue working independently when subjected to simultaneous stress. The mathematical reality was more complex than any single institution could calculate. When stock prices began falling, margin calls forced simultaneous selling across all sectors, accelerating the decline that triggered more margin calls. When one regional banking network collapsed, depositor panic spread to seemingly unrelated institutions, creating the nationwide runs that diversification was supposed to prevent. When the Federal Reserve tightened monetary policy to defend the currency, it amplified the deflationary pressure that was already destroying bank balance sheets. When international trade contracted, the gold standard transmitted deflationary pressure globally instead of containing it locally. What the system hadn't priced was the possibility that its own stabilizing mechanisms could become destabilizing when activated simultaneously. Banks had calculated reserve requirements based on normal withdrawal patterns, not coordinated nationwide panics. Investors had calculated margin risks based on historical price movements, not system-wide liquidation events. Policymakers had calculated intervention strategies based on isolated problems, not cascading failures across multiple interconnected systems. The sophistication of 1920s financial engineering had created new forms of systemic risk that weren't visible in historical data because they had never existed before. Holding companies created concentration risks that looked like diversification. Margin lending created correlation risks that looked like expanded opportunity. International monetary coordination created transmission risks that looked like stabilizing integration. Each innovation solved previous problems while creating new vulnerabilities that wouldn't become apparent until the entire system faced unprecedented stress. And the reason this hasn't been reflected in price yet is not what most people assume. If you're interested in understanding markets beyond headlines, this channel focuses on exactly that. The widely accepted narrative of the Great Depression follows a familiar progression from prosperity to excess to inevitable correction. According to this standard account, the Roaring Twenties created unsustainable speculation that naturally led to the 1929 crash, which revealed underlying economic weaknesses and forced a painful but necessary readjustment. This explanation satisfies our need for simple causation, while fitting comfortably within conventional economic frameworks that treat market cycles as natural phenomena with predictable patterns. The timeline appears straightforward enough to support this interpretation. Post-war prosperity accelerated through the 1920s as industrial productivity soared and consumer goods became widely available. Automobile production revolutionized manufacturing through assembly line techniques that reduced production time from 12 hours to 90 minutes. Radio ownership exploded from virtually 0 to 10 million households by 1929, creating the first truly national media market. Urban centres flourished as electricity and modern appliances transformed daily life, while financial markets provided increasingly sophisticated mechanisms for channeling capital toward productive investment. Institutional behaviour during this period followed patterns that seemed rational and sustainable. Banks expanded lending to meet growing demand from both businesses and consumers, using installment plans that allowed ordinary Americans to purchase automobiles, appliances, and homes with manageable monthly payments. Stock exchanges facilitated unprecedented levels of investment activity, democratizing participation in financial markets that had previously been restricted to wealthy elites. Corporate holding companies emerged to capture economies of scale and scope, creating more efficient organizational structures for managing complex business operations across multiple markets and industries. Capital flows during the 1920s appeared to validate these institutional innovations. Foreign investment poured into American markets, attracted by superior returns and political stability relative to war-torn Europe. Domestic savings found productive outlets through expanding financial intermediaries that matched investor funds with borrower needs more efficiently than previous generations had achieved. The Federal Reserve System provided monetary stability that supported steady economic growth without the dramatic boom-bust cycles that had characterized earlier periods of American development. This interpretation treats the stock market crash as the inevitable result of speculative excess that had pushed asset prices beyond sustainable levels. When reality reasserted itself through falling stock prices, the correction revealed underlying structural weaknesses that had been masked by artificial prosperity. Banks had made too many risky loans, investors had borrowed too heavily against uncertain future returns, and businesses had expanded beyond what genuine consumer demand could support. The subsequent depression represented a painful but necessary process of eliminating these excesses and returning the economy to a more sustainable foundation. Even the international dimension fits neatly within this conventional framework. American prosperity had created trade imbalances that were ultimately unsustainable, while the gold standard provided automatic adjustment mechanisms that would restore equilibrium through deflation and reduce domestic demand. When other countries experienced similar corrections, global trade contracted to more realistic levels that reflected actual productive capacity rather than artificial credit expansion. The worldwide nature of the depression simply demonstrated how thoroughly speculative excess had penetrated international markets. This narrative provides psychological comfort by suggesting that market systems contain self-correcting mechanisms that prevent permanent damage to economic fundamentals. Speculation creates bubbles. Bubbles burst, reality reasserts itself, and stronger foundations emerge from the wreckage. The pain is temporary and the benefits are permanent because markets learn from their mistakes and develop better risk management practices that prevent similar problems from recurring. Federal Reserve policy during this period appears to validate this interpretation because central bankers consistently acted to defend monetary stability against speculative pressures. When stock prices rose too rapidly, they raised interest rates to cool excessive enthusiasm. When international investors threatened currency stability, they defended the gold standard to maintain confidence in American monetary policy. When banks faced liquidity pressures, they provided emergency lending to prevent unnecessary failures, while allowing insolvent institutions to close in an orderly manner. This is the part most people understand. The part that actually changes the outcome comes next. The mathematical flaw wasn't in the individual calculations, but in the shared assumption that different risks would remain independent when the system faced pressure. Every institution had correctly assessed historical patterns within their specific domain, but none had modelled what happened when those domains stopped behaving as separate systems and started reinforcing each other's vulnerabilities. The margin lending system provides the clearest example of this hidden interdependence. Banks calculated loan-to-value ratios based on individual stock performance over time, assuming that borrowers would face margin calls randomly and independently. This assumption held when market stress remained scattered across different sectors and time periods. But the mathematics changed completely when margin calls began triggering simultaneously across thousands of positions, forcing coordinated selling that drove down the very collateral securing the loans. The regional banking network revealed similar structural blind spots. Caldwell and Company's expansion across Tennessee, Kentucky, Arkansas, and North Carolina had been explicitly designed to reduce concentration risk by diversifying geographic exposure. The mathematics supported this logic under normal conditions, because different regions historically experienced different economic cycles. Agricultural areas might struggle, while industrial centres thrived, or vice versa. But rarely did all regions face identical pressures simultaneously. What the diversification strategy hadn't accounted for was the possibility that geographic separation would become irrelevant when depositor psychology shifted from local concerns to systemic doubt. Once confidence collapsed, state borders provided no protection against bank runs because depositors were responding to national rather than regional information. The same communication networks that had enabled efficient business operations across multiple states now transmitted panic at speeds that made geographic diversification meaningless. International monetary policy demonstrated perhaps the most sophisticated version of this mispricing. The gold standard operated on elegant mathematical principles that automatically balanced trade flows through interest rate adjustments and gold movements between countries. When one nation experienced capital outflows, rising interest rates would reduce domestic demand, lower prices, and restore competitive balance. This mechanism had successfully managed international commerce for decades, creating confidence among policymakers that global integration enhanced rather than threatened monetary stability. The flaw emerged when multiple countries faced simultaneous pressure to defend their currencies against capital flight. Instead of the orderly adjustment that mathematical models predicted, the system created a deflationary spiral where each nation's attempts to preserve monetary stability forced other nations to implement even more restrictive policies. The gold standard had been designed to manage isolated currency pressures, not coordinate global deflation. Federal Reserve policy reveals how even the most sophisticated institutional responses could amplify rather than contain systemic risk when underlying assumptions proved incorrect. Central bankers possessed extensive historical data about banking panics and had developed intervention strategies based on decades of successful crisis management. Their decision to raise interest rates in 1931 followed established protocols that had previously restored confidence during currency attacks. The critical mispricing was in the assumption that monetary tightening would affect confidence and capital flows without significantly impacting the broader economy. In previous episodes, higher interest rates had successfully defended the currency, while economic fundamentals remained stable enough to absorb temporary monetary restriction. But when the banking system was already under severe stress from collapsing asset values and coordinated depositor withdrawals, the same monetary policies that had once restored stability now accelerated the deflationary pressure that was destroying bank balance sheets. This pattern repeated across every major institution and policy framework that had successfully managed previous economic challenges. Stock exchanges had developed margin requirements based on historical volatility patterns that didn't account for system-wide liquidation events. Insurance companies had calculated reserve requirements based on regional disaster patterns that didn't account for nationwide economic collapse. Corporations had optimized supply chains and inventory management based on demand patterns that didn't account for simultaneous purchasing power destruction across all customer segments. Each institution had been solving the right problem under normal conditions, but normal conditions assumed that different types of stress would remain isolated and manageable through established procedures. The system-wide mispricing wasn't in any individual calculation, but in the collective assumption that successful historical patterns would continue working when subjected to unprecedented simultaneous pressure across all interconnected components. The mathematics of compound system failure operate differently than the mathematics of isolated component failure. When individual parts of a system fail independently, the remaining components can often absorb the stress and maintain overall stability. But when multiple components face coordinated pressure, their attempts to preserve individual stability can create feedback loops that overwhelm the entire system's capacity for self-correction. The 1920s economic system had evolved sophisticated mechanisms for managing normal stress, but these same mechanisms became sources of additional stress when activated simultaneously. Banks maintained liquidity by borrowing from other banks, but when all banks faced liquidity pressure simultaneously, this interconnectedness transmitted rather than absorbed the shock. Investors managed risk by diversifying across different asset classes, but when all asset classes faced selling pressure simultaneously, diversification provided no protection against coordinated liquidation. The underlying mathematical reality was that the system's stability depended on different types of stress occurring at different times, allowing the various stabilizing mechanisms to operate independently. When economic, financial, and monetary pressures converged simultaneously, the stabilizing mechanisms began interfering with each other in ways that no individual institution could predict or control. This interference pattern explains why the collapse accelerated rather than stabilized despite massive intervention efforts by every major institution. Each attempt to restore stability in one area created additional pressure in other areas because the underlying assumption of independent operation no longer held. Bank lending restrictions designed to preserve capital adequacy reduced business activity, which lowered tax revenues, which increased government borrowing needs, which competed with private investment, which reduced economic activity further. The system doesn't fail here, it tightens. What makes this pattern particularly relevant for understanding modern financial systems is how thoroughly it contradicts conventional risk management approaches that treat different types of risk as mathematically separable and manageable through diversification. The Great Depression demonstrated that sophisticated financial engineering can create new forms of systemic risk that aren't visible in historical data because they emerge only when multiple innovations interact under extreme stress. The persistence of similar mathematical assumptions in contemporary risk models suggests that current financial systems may be vulnerable to comparable mispricing when their own stabilizing mechanisms face coordinated pressure. Modern portfolio theory, stress testing methodologies, and regulatory frameworks all operate under variations of the same fundamental assumption that proved catastrophically wrong in 1929. The belief that different types of risk can be managed independently through sophisticated mathematical modeling and institutional diversification. The critical insight isn't that the 1920s system was uniquely flawed or that its participants were uniquely naive. The mathematical sophistication and institutional innovation of that era represented genuine advances over previous approaches to financial management. The mispricing emerged because these advances created new forms of interdependence that weren't captured in historical data or conventional risk models. This is what remains unpriced for now. The possibility that mathematical sophistication and institutional innovation can create system-wide vulnerabilities that only become visible when the entire system faces unprecedented stress. The assumption that different types of risk will continue behaving independently, even when the mechanisms designed to manage them are forced to operate simultaneously under extreme pressure. The Great Depression offers a mathematical proof of concept that sophisticated risk management can create the very systemic vulnerabilities it was designed to prevent. Every institution operated under assumptions that were individually rational, historically validated, and theoretically sound. The collective failure wasn't due to ignorance or recklessness, but to the fundamental mathematical reality that complex systems can exhibit behaviors that emerge only when multiple components face coordinated stress simultaneously. The persistence of similar assumptions in contemporary financial architecture suggests that current systems may be vulnerable to comparable mispricing. Modern risk models, regulatory frameworks, and institutional practices operate under variations of the same core belief that proved catastrophically wrong in 1929, that different types of risk can be managed independently through mathematical modeling and diversification strategies. What remains unpriced isn't the possibility of individual institutional failure, but the mathematical reality that sophisticated stabilizing mechanisms can become sources of instability when activated simultaneously. The assumption that historical patterns will continue working when subjected to unprecedented coordinated pressure across interconnected systems. The belief that complexity and innovation reduce rather than transform systemic risk. The Great Depression demonstrated that reality moves first, price follows later. Mathematical sophistication had created new forms of interdependence that weren't visible until the entire system faced stress that had never existed before. Current financial systems exhibit similar patterns of increasing complexity, interconnectedness, and confidence in mathematical models that may be pricing risks that no longer exist, while ignoring risks that have never been tested.